What's up, guys? It's Rowan
and Terry
from ArtofSmartTV, bringing you another episode of
HSC Economic Review.
Now, with a cash rate at a low of 0.75%, we've got unemployment trending upwards, right? It's at 5.3%. Wage growth is falling. Okay, it's 2.2%. We've got inflation still pretty horrible, 1.7%. The big question that is being asked right now is what's next for monetary policy in 2020? And specifically, right, will further reductions of the cash rate have any impact? And then secondly, if not, what on earth can the RBA do to actually try to deal with the ongoing economic challenges we face? So in this video, we're going to be diving in to discussing negative interest rates, quantitative easing, and more. Personally, I'm pretty pumped about this episode because I think it's a pretty interesting area of monetary policy for the Australian economy that we haven't really seen here before. So, Terry, in terms of jumping in, I want to ask you a question, and that question is the current monetary policy reductions, right? We've had a couple of reductions now to get to 0.75. Is it having an impact?
Well, I think we could see that there definitely is an impact, but I wouldn't say it's necessarily the impact that we might have hoped for. So as you mentioned earlier, Rowan, unemployment is going the wrong way. And one of the main key factors which, kind of inspired these consecutive drops or three drops that we've had was to basically get rid of that spare capacity in the labour market. And if that's not happening, then it's not really targeting what it was supposed to. And I think that goes back to just the idea that monetary policy is what we call a blunt instrument, right? And it often can have some unintended effects. So such as if you were aiming to bring yourself back closer to the Nauru, but it just didn't happen. Right?
That's right.
But there is some good news.
Well, I think that the worrying thing, just before I really quickly I think the worrying thing as well is that, 5.3%, okay, so unemployment has worsened. There's more, like light now between the Nauru of 4.5 and unemployment than there has been for quite some time. And it's interesting, we've now had the largest unemployment rate since March 2017, right? So we're sort of seeing it go the wrong way, and all of the forecasts indicate that it's going to get to 5.5 and beyond for next year. And that's despite the current low cash rate. So I think it's certainly concerning there. I think, probably the only thing that we should, before we sort of dive in any further, is highlight that, look, there is an 18-month time lag here, typically, for the full effects of monetary policy to be borne out. So we are, maybe too early in the sort of cycle to be able to effectively commentate on the extent to which it will be effective. I think we can certainly say right now, relating to unemployment at least, it's probably not having that effect. I think the area that it is perhaps having a positive effect, and positive I say this with a question mark, is that we are seeing impacts via the asset price channel, okay, in terms of the transmission mechanism. And that basically just is the idea that as our cash rate falls, it tends to elevate the prices of assets, right? And we're certainly seeing that with housing prices. We saw a dip occur earlier on in the year, and really since the three consecutive cuts, we've really seen an increase once again. And really the housing market has roared back to life. You look at clearance rates going through the roof again, property prices really bouncing back, and analysts say it's really like the fastest sort of bounce back they're really seeing as a result. And I think that's purely as a result of the cash rate reductions.
Oh, okay. Because I would actually argue against that, just simply because I think with the housing market, because it was so strong, and because I personally believe it is in a case of a bit of a bubble at the moment. This was just a correction. And so I don't really necessarily know if it was this recovery was driven by monetary policy.
So you're saying you think it's actually just
a natural,
and not even a true correction, because a true correction is when the bubble collapses, right?
But it was
this is almost like just a return to pre-bubble conditions, really, right? It was like a little lapse, right? Now look,
and now it's just roared back.
That's one way to look at it. I feel like at least monetary policy reductions influenced those expectations. I think maybe not, and we'll see that, right? I think one of the things that it's clearly had an incredibly muted effect in is the savings and investment channel, right? Which I think indicates and goes to your point here, Terry, that maybe, the cash rate reductions didn't really drive a lot of, appetite for increased borrowings, which then caused the housing market to boom again. And maybe it was just expectation. Okay, because what we see, what do we see? What does the data say about the extent to which the cash rate reductions are actually flowing through into disposable income? So specifically what I mean is, are people actually reducing their mortgage repayments so they've got more money to spend?
Well, I would have just thought that usually when people have such low interest rates, and they have had for such a long time, that if it does reduce, it's really just about paying off existing debt rather than actually taking on more borrowing.
That's right.
And I think we need to actually take a closer look at, who are these people who are buying these properties. Is it necessarily people who are taking on more borrowing, or people who are looking for investment properties, or is it potentially other parties?
And I think that's where we can look. There's some really interesting data that came out which said that less than 10% of Australians with a variable interest rate, like for their home loan. So variable means that as the cash rate falls, that interest rate will fall, okay? And it goes up as well. So less than 10%, as the rates have been cut, have then gone to their bank and said, great, now that the rate's lower, we want to reduce the amount of mortgage repayment we're paying. Now, if you were to do that, you would then have greater disposable income to go into the market, to consume on goods and services, which is what the RBA wants you to do. Yeah. And so therefore, if it's less than 10%, we're really seeing that actually very few people are actually increasing their disposable income to go out and consume through the saving and investment channel. They're just paying down the debt. So the point is that actually a cash rate reduction is therefore having very little impact through the savings and investment channel. I mean, if you look at it, Commonwealth Bank, the number one home loan provider, right, had out of 1 million customers, they said only 69,000 people reduced their payments, okay? Which, my math says that's 6.9%, which is even less than the 10% that's quoted across the board. So you can see that, it's probably no wonder maybe, that the RBA's cash rate reductions aren't having an impact, when really the savings and investment channel, honestly, is probably their strongest channel, right? Really to affect change in the economy. Now, what about wage growth? What's wage growth been doing?
Wage growth has not been doing very much. So there was a report issued by the Australian Bureau of Statistics saying that the wage price index did rise by 0.5% in September, but it is really just at 2.2% for the year, which is actually lower. I think we've been before the HSC. I think we're going at 2.3%.
That's right. So we've actually seen a slight drop, right? Yeah. Which is again going backwards, right? Despite successive cuts. So I think what this highlights is that we look at the immediate effectiveness right now, and we are early in the time, the sort of time cycle for the full effects of a cash rate reduction to be played out. Mm-hmm. I think we could certainly say that right now it's not having the effect that was desired. Yeah. Now, I suppose that the question is, do further reductions of the cash rate will they have any impact? Because I mean, in many cases, when we think about traditional monetary policy, we mainly think of the lever, and the lever just being an increase the cash rate or reduce the cash rate, right? So right now, it seems like the RBA is faced with a reduction of cash rate as their next strategy again. Mm-hmm. Will that have any impact, Terry?
Well, I think we need to understand that, as we've seen with this, 10% and 6.9% and 7% of customers actually acting due to these reduced cash rates.
To just pay off debt,
just to pay off debt. There is a very low level of elasticity. People are very unwilling to really act on these. So I think if they continue to drop this cash rate, we're just going to continue to see diminishing returns. Clearly they are paying down debt rather than actually going out and actually increasing their consumption. And so if we are going to keep dropping that cash rate, I'm not convinced it's really going to have the effects which the RBA is hoping for. Although I will say that our inflation did actually tick up a little bit from
that's probably the one positive.
1.6 to 1.7% in the last quarter.
Although the question is, was that a result of the cash rate, or was that a reduction of October being tax tax month, right? And the fiscal policies, low to middle income tax offset. I think maybe it was more a result of that. Yeah. Because that puts money in people's purse, right, directly to go and spend, rather than necessarily just keep on paying the mortgage back and repaying debt.
Which does kind of tie into the idea that monetary policy and fiscal policy do have to work together and coordinate. Right.
So then what can, it's a little concerning then, because what we've just highlighted is, all but one of the key economic indicators have gone the wrong way. And we've just come to the statement that future reductions in the cash rate are not going to have the desired effect in actually moving those in the right direction. I'm sort of worried, right? What else can the RBA do to try to affect change in the economy?
Before we get to what we call the unconventional monetary policy tools, I think they do still have one more trick up their sleeve, which they have been applying plenty of pressure, plenty of jawboning on fiscal policy, as we were saying earlier. I think Governor Lowe has been very vocal on encouraging fiscal spending on infrastructure and bringing that forward.
And tax cuts forward. I think the two big things he's talked about is looking at future expenditure, bringing it forward. It will change the budget outcome, of course, though, from a surplus to a deficit, and clearly, you know, Liberals are very reluctant to do that. Sorry, continue.
So I think that we still have that, and I think it's going to continue to play a role. But obviously, you know, at the end of the day, you can only talk so much. Your jaw can only bone so hard. And if we do need to go even further, Rowan, what are some of these unconventional tools?
So look, I think one of the big unconventional ones, at least for Australia, I mean, I think as we're going to unpack in a moment, it's certainly become more conventional over the last decade for the rest of the world, and that's quantitative easing. Now that might sound a little, you know, like what the hell, but simply right, it's an expansion of open market operations of a country's central bank. Now again, you might think, well, okay, an expansion of open market operations, but these should be terms that you're familiar with in just understanding monetary policy. So in essence, right, what a central bank will do is that they will buy mortgage-backed securities. Now, what is a mortgage-backed security? We've got another definition that we've got to unpack here. Essentially, you know, a bunch of people take out mortgages. A bank brings all these mortgages together, it groups them, and it then sells it as a group of mortgages. That's essentially what a mortgage-backed security is, very simplistically communicated. Now, what they can do is they can buy a bunch of these mortgage-backed securities from the banks, typically, okay, and in doing so, they add liquidity into the flow of money into the capital markets. Now, it's really interesting because actually no money actually exchange hands.
Yeah, I think the important thing to mention is that the money is actually just essentially created out of thin air. Right, and so they've actually just credited their balance sheets and just went with it, really.
So basically, they're saying, "Hey, banks, you can sell us all these mortgages that you've got, and we'll pay you, but we're just going to make this money up. Right? We're just going to add some credits, add some digits to your bank account, and say you've now got more of this."
But available. It's not backed on anything.
No, exactly. It's not backed.
It's just been created out of thin air.
And so, in other words, that's why we get this idea that we're increasing the money supply. Now, of course, the RBA in the old school days would have physically printed money, right? Like physically printed it, would have then through their direct regulation of banks pushed it out. So this is a really, in a deregulated financial sector, right? The pathway that the RBA can take to in effect increase the money supply. I think to think about this, right, as I said, it's unconventional for Australia, but it's not necessarily unconventional for other countries around the world. Who else has been using this?
Good old Japan. It's funny because Japan were the first to actually use quantitative easing because they just have had such struggles really with consumption. They've really struggled to get consumers to take the money out of the banking sector. And so they have used quantitative easing as well. But funnily enough, I actually saw a quote from them and they basically just said it wasn't very effective for them. They just said wasn't effective. More effectively though, who has?
I think probably the most effective use of quantitative easing that we've seen was the US economy, really. The US Fed started using it in 2008 off the back of the GFC. They ran it all the way through to 2014. They added almost $2 trillion to the economy. Now, it was certainly successful in the earlier period. Okay, and that's again some of the analysis that's come out of it at the back end is that, look, at earlier times, particularly GFC period, it was really critical. As time moved on, it became sort of challenging in terms of transitioning out of quantitative easing. And I think that's often the criticism that it has, is that once you start it, it can be challenging for an economy to, it's almost like a hangover, right? And it's like, it's hard to get over, and maybe that's an inappropriate reference to be making.
There are kids watching.
Maybe after not getting any sleep for a night and you're feeling really tired the next day. That's the PG version, right? But I think that's one of the criticisms of QE, okay? So the US certainly very successfully. Also, the European Central Bank has also adopted it. They adopted it in 2015, after 7 years of austerity measures, right? Going, okay, we've got to reboot. So we've got the US and the EU using this, right? We've got Japan, we've got some of the largest economies in the world using this. We've probably been fortunate that we haven't had to get there yet. Now, that's one option, Terry, but there's another. What's another alternative method of monetary policy?
I'm gonna go with negative interest rates. But before I get into that, I just wanted to add a little bit just to, if this is the first time you've heard about quantitative easing, you might be wondering why it's called QE or quantitative easing. I saw something which was really brilliant. It actually just summed it up very nicely. It's called quantitative easing because when you get to, and it's only used when you have very, very low interest rates. It's called that because when you have such low interest rates, you can no longer affect the money supply through the price. And if you remember just with your basic economic graphs, it's either price or quantity. Usually you can affect both, right? Price and quantity. But if you lose the ability to influence price, the only thing you can change is quantity. And so you use quantity quantitatively to ease the monetary policy. And I think that just really ties it up very, very nicely.
Nice.
It just because, you know, if it is the first time you've come across this, and I am conscious as well, just because having taught, you know, HSC Economics for 2 years now, basically, this is definitely not something which is in the syllabus. So Rowan, just in terms of that, what would you ask your students to maybe include or not include?
Yes, I think
how would they integrate
it's definitely, yeah, you're right. It's not part of the syllabus, but I think it becomes part of your analysis around, okay, you know, if monetary policy, further reductions are going to be ineffective, okay, I think one of the things that you could just simply mention is that an alternate option that the RBA may need to consider using is quantitative easing, as you know, it has been used in Japan, the US, and the EU, to further increase the likelihood of.
So students wouldn't really need to explain in super detail.
I think we've explained it here just so you understand it, right? But yeah, literally you would be referencing it as an alternate, an alternate tool that the RBA could use. You mentioned that there was a negative interest rates as an alternate. What is that? I'd love you to dive in. How does it work?
Well, basically,
sounds crazy.
It does. You get in a situation where you need to reduce unemployment. You need to bring some inflationary pressures in the economy. You have no choice. You've run out of room, essentially, right? Like, we're currently sitting at 0.75%.
It's not that far to zero, right?
Yeah, and eventually you get down to zero, and if maybe even negative, okay? And that is, I guess, what you'd consider to be a very hyper-expansionary stance with monetary policy, because at that stage, what you're doing is essentially penalising the commercial banks for holding their deposits with the central bank. Now, when they are being penalised, what does that mean? How does that flow on to the rest of the economy?
Well, yeah, I mean, in most cases, the banks are going to want to pass that on, okay? So they're also then going to most likely pass that on to, deposit holders, right? So if you've got money saved in the bank will go, well, great, we'll hold that for you,
but we're
going to charge you for it, right? And so you get penalised, in other words, for saving money. So the implicit idea here is that what they want you to do is to move that money into other asset classes, okay? They want you to either just spend it on consumption, of course, or move it into property and shares. And, again, it tends to drive maybe the asset asset price channel a little bit more, but it also does fall into savings and investment channel because you're going, well, I don't want to save anymore, right? It's penalising me for saving. Now, it's interesting though because it creates on the flip side a little bit of a crazy outcome, Terry. What's the crazy outcome that gets created here? Like, as in, am I getting paid to borrow money? Is that what it means?
So yeah, essentially, if the bank product does have a negative borrowing rate, then you will be paid essentially to take on. And the point is that at that stage, you are being rewarded for your risk taking. So I would imagine those negative interest rates would probably be for more riskier assets, so loans to purchase more risky assets. And because that's the point, at that stage, you are rewarding risk takers and you are punishing risk averse people.
Which is so counterintuitive, really. In terms of the norm. Now, I think, again, this isn't something that is, again, it's more common globally, again. It's not something that no one else is doing. Australia's going to be the first, Sweden. In 2009, okay, again, GFC zone, right, cut their overnight deposit rate to negative 0.25%. The European Central Bank is at, in 2014, they had 0.1. I think what's really interesting is if we look at it now, like right now, the ECB, European Central Bank's equivalency to our cash rate is minus 0.5. Okay, Japan is minus 0.1. And these are probably things that you weren't aware of, right? And it's crazy to think, well, actually, some of the largest countries and economies in the world have negative interest rates right now. And that, I think, says a lot because our monetary policy is ultimately heavily influenced by global conditions. And so if the globe are in this situation,
Yeah.
Like, it's probable we're going to get there. Now, a question for you, Terry, is what's going to be... Because the impact of this isn't necessarily all good, right? Negative interest rates actually have a couple of negative consequences as well, right? So outside of, hopefully increasing asset prices and encouraging consumption, what are some of the negative consequences of negative interest rates?
It creates a set of winners and losers. Mm-hmm. And I think the losers in this case are the risk averse. And as Rowan was saying, that shouldn't be fair. Like, you should not be punished, right, for being wise or being good with your money, saving some of it up. And so it does ultimately reward those who have invested in more risky assets. At the same time, I've seen that in some cases it can actually cause a bubble to start to form in those particular asset classes, just because you get such a rush of capital flowing into those assets, which can really just bump up those prices and cause a bit of a bubble.
And arguably we're maybe seeing a little bit of that, right? Housing certainly. What else? What's one of the other impacts? Because I think it's already maybe it should be maybe a concern for Australia a little bit.
Well, of course, if we just think back to what we've been learning about the exchange rate, whenever we start to get a smaller positive or maybe even a negative differential with the rest of the world, that is going to discourage inflows into the Australian economy, and that is going to put further downward pressure on the Australian dollar. Now, that brings, of course, obviously a whole range of disadvantages, right, relating to we've already made a video on this, haven't we, about how the dollar has been so low. Can you just give us a quick recap of what those were? Yeah, so I think that the key thing with the dollar being really, really low is we get a couple of things occur. We get trade impacts, okay? So while, yes, our international competitiveness improves, which is... But it's more so in the long term. Fantastic, right? Yeah. I think, our imports certainly cost a lot more, okay? So that can have consequences for our bogs. Yeah. We've also got valuation effects on our net foreign debt, net foreign liabilities, which can increase the value of the payments that we're needing to make. So that current account surplus really isn't going to stay. No, that's right. Exactly. So we can see that there are definitely some consequences. So just as we sort of wrap up here, Terry, I guess overall then, what do we think monetary policy is going to look like in 2020? Well, I think there really is room for more cuts. I think it's been quite clear that this is not the last one. And I think if we just look globally, I think often just seeing how China is probably going to settle at around 5 to 6% as its new standard. The Eurozone continues to be quite weak, and Brexit, of course, looms over our heads. And of course, the US is also fighting its own trade dispute with China. I just honestly, it doesn't fill me with optimism, and I think we are going to go down, and we might actually start to see some of these things we've talked about today play out, the quantitative easing, the negative interest rates. Which I think is going to be really interesting for an economics student, certainly interesting for the economy as well. But it's certainly going to make 2020, I think, an exciting year. Awesome, guys. Look, if you have any questions about whatever we shared today, you want to get your head around QE, negative interest rates still confusing you, monetary policy, whatever it may be, leave a comment below. Terry and myself will do our best to answer it, or maybe bring it on to a topic idea for some of our future episodes for the HSC Economics review. If you haven't already yet, hit subscribe. We'll have more episodes for you, giving you up-to-date analysis on what on earth is happening in the economy as it relates to the HSC Economics course. And of course, we will see you next episode.